Welcome to the Tim Booker channel, where wisdom deserves to be spread. We wish you a pleasant listening experience. Today, I will be interpreting A Random Walk Down Wall Street for you. This book contains approximately 300,000 words, and I will summarize its essence in about 20 minutes. It delves into the use of the random walk investment approach in the American market to steadily grow one's investment returns. But first, let's start with a story. In 1593, a botany professor transported tulips from Vienna to Leiden in the Netherlands. The Dutch became infatuated with these flowers and began investing heavily, causing tulip prices to soar for over 30 years. By January 1637, tulip bulb prices had increased 20-fold. However, this was the peak of the madness. Just a month later, tulip prices plummeted even faster than they had risen, soon becoming nearly worthless. Does this story sound familiar? In fact, that tulip mania from centuries ago was the world's first recorded financial crisis. Since then, we've witnessed events like the 1929 Wall Street crash, the early 21st century American real estate bubble and subprime mortgage crisis, as well as two significant stock market crashes in 2008 and 2015. These recurring investment stories raise the crucial question: how can one avoid investment pitfalls and achieve stable returns? That's the burning question for every investor, and the book, A Random Walk Down Wall Street, aims to provide answers. The book's title is a clever play on words, suggesting that, on the surface, it's about strolling on Wall Street, but in reality, it implies that adopting the random walk investment method is the key to effortless and successful investing. So, what is a random walk? Originally a mathematical and statistical model, it is now applied in various fields like ecology, economics, psychology, and more. In the field of economics, a random walk is essentially an investment approach that respects the randomness of the market's patterns. The author of this book, Malkiel, suggests that by employing the random walk investment method, investors are more likely to achieve steady growth in their returns. Speaking of A Random Walk Down Wall Street, it enjoys a stellar reputation. Forbes has praised it as one of the true classics in investment literature, with only a handful of comparable works in the past 50 years. Now, let's talk about the author of this investment classic. Burton G. Malkiel is both a finance scholar and an experienced investment manager. He has held positions such as director of the Financial Research Center and chairman of the economics department at Princeton University. He also served as a member of the President's Economic Advisory Committee in the United States and spent 8 years as the dean of the Yale School of Management. Additionally, Malkiel held key roles at several investment firms, including Vanguard Group and Bode Credit Financial Group. Having covered the book's background and the author's profile, we'll now dive into the details of its content. First, I will explain why neither technical analysis nor fundamental analysis can predict the stock market. Then, we'll explore how to overcome the randomness of the market, our greatest adversary in investing. Finally, we'll discuss how to choose the right random walk investment method for your investments. Let's start by looking at the first key point: why both technical analysis and fundamental analysis cannot predict the stock market. Malkiel believes that the market is random, and short-term fluctuations in stock prices are unpredictable. So-called stock price predictions, earnings forecasts, and complex charts are essentially useless for stock selection. In other words, an investment portfolio chosen randomly by a blindfolded monkey is just as good as one selected by so-called market experts. Investment professionals naturally disagree with this assertion. They argue that they can use technical and fundamental analysis, something a monkey cannot do. However, can technical and fundamental analysis really predict the stock market? Let's first examine the popularity of technical analysis. What is technical analysis? Essentially, it involves studying and interpreting stock charts to predict price movements. Why do many people find it useful? Because technical analysts believe that all information related to a company's earnings, dividends, and future performance is already reflected in past stock prices and trading volumes. Stock movements also follow certain trends, making technical analysis seem necessary. Furthermore, they think that only 10% of the stock market can be approached from a logical perspective, while the remaining 90% should be analyzed psychologically. By studying charts, they believe it's possible to understand the future actions of all market participants, thereby grasping market trends. This is because the value of an item is equal to what people are willing to pay for it. Due to this focus on market participants' psychological factors, the theoretical foundation of technical analysis is often called the castle in the air theory. John Maynard Keynes, a famous American economist, firmly believed that mass psychology was the key to continually pushing stock prices to new highs. As long as there are fools willing to buy, even if a stock is worthless, you can still make money. However, Malkiel argues that technical analysis is fundamentally unreliable because its logical premise is shaky. Analysts study past stock charts because they believe that historical price changes have value as references for today. In other words, history can repeat itself today. However, scholars have thoroughly examined the operating rules of technical analysis using stock price data from major U.S. exchanges since the early 20th century. The results show that past price changes cannot serve as a reliable basis for predicting future price changes. Stock price increases or decreases have little to do with history. The belief in the existence of repetitive patterns in the stock market is considered a statistical illusion. To illustrate the impact of this illusion, Malkiel once had his students conduct an experiment. They set the initial stock price at $50 and then used coin flips to determine daily price changes. Heads meant an increase of 50 cents, while tails meant a decrease of 50 cents. This generated a stock price chart that looked very similar to a normal one, even showing periodic fluctuations. When Malkiel showed this chart to a technical analyst, the analyst enthusiastically asked, "Which company's stock is this? We need to buy it immediately. This pattern is so classic. This stock is sure to rise by 15 points next Monday." This experiment demonstrated that stock price changes resemble a random process. Technical analysts overlook this fundamental premise, which is why they become so obsessed with stock charts. Because technical analysis is closely related to mass psychology, many technical analysts are not satisfied with just studying price changes. They have also come up with various absurd correlation studies, such as the famous hemline index theory. This theory suggests that when women wear miniskirts, it signals an impending bull market, while when they prefer long skirts, it indicates a bear market. This theory seemed to work before World War II, but it lost its magic after the war. The time when women choose long skirts sometimes precedes a bear market, sometimes follows it, making this theory meaningless for predictions that are in the face of market randomness. Malkiel believes that employing technical analysis is highly risky. This is because historical stock prices provide no reference value for future stock prices, and there are no discernible trends in the stock market. Instead of relying on chart analysis and frequent buying and selling, it's better to simply buy and hold stocks for the long term, as this at least reduces transaction costs. Since technical analysis doesn't offer substantial assistance in investing, what about fundamental analysis? Malkiel is equally skeptical. He attempts to predict a stock's future price movements in the market by analyzing its true value, such as its current operational status, earnings level, and more. This logic may seem more reasonable than technical analysis. In fact, Wall Street analysts are primarily fundamental analysts, making investment decisions based on their understanding of various companies. While gaining an in-depth understanding of a company's current state and true value is beneficial, does fundamental analysis really work? This question is relatively easy to answer. Just look at the investment performance of securities analysts. Numerous studies have found that investment funds managed by professional analysts do not yield better returns than unmanaged large stock market indices. In other words, paying for professional assistance in fundamental analysis and then investing is not significantly more profitable than randomly selecting a few stocks and leaving them be. While certain funds may perform well during specific periods, this performance lacks consistency. In the 1990s, the Wall Street Journal even proposed a dart-throwing contest in which 4 Wall Street experts selected stocks to compete against a portfolio of stocks chosen randomly by tossing darts. The results showed little difference in performance between the two methods. This raises the question, aren't stock prices determined by a company's value? Malkiel argues that numerous factors affect the predictions of fundamental analysts, including the influence of randomness. Many critical changes that impact a company's profit prospects are fundamentally random and unpredictable. For example, in the early 21st century, Wall Street's predictions for the future of the high-tech industry were wildly inaccurate. Even the venerable investment bank Goldman Sachs, in a mid-2000s research report, stated that there was no long-term risk in the internet sector. However, just a few months later, hundreds of internet companies went bankrupt. Other factors, such as mismanagement, the unexpected emergence of significant new products, and major natural disasters or accidents, can lead to abrupt stock price declines for companies that seemed promising. Furthermore, corporate dishonesty, often involving unreliable financial statements, can affect stock price predictions. Many companies frequently create unreliable financial reports. Malkiel likens a company's profit statement to a bikini. It reveals what's interesting but conceals what's essential. During the late 1990s bull market, many companies increasingly fabricated lies to make their financial reports look better. Even well-known companies like Kodak, Xerox, and Motorola engaged in financial statement shenanigans. Wall Street analysts faced with falsified financial reports found it difficult to make accurate stock price predictions. Malkiel concludes that, given these challenges, both technical analysis and fundamental analysis are unreliable in the face of market randomness. This summarizes the first key point I've discussed for you. Having discussed that, let's move on to the second key point: how to overcome the greatest enemy of investing, market randomness. Based on the analysis we've just covered, we now understand that both technical analysis and fundamental analysis are not entirely reliable. So, what should investors do? Malkiel suggests taking a middle ground. While technical analysis is not entirely dependable, its theoretical foundation, which considers the influence of mass psychology on stock prices, has some merit. As for fundamental analysis, even though it can't predict the future with precision, gaining a basic understanding of industry and company fundamentals can provide a general assessment of stocks. However, both approaches are influenced by randomness. Since we're aware that randomness is the defining characteristic of the stock market, why not develop investment strategies based on this pattern? Through extensive research, academia has created some new investment techniques that may help us achieve higher returns while reducing investment risks. So, what's the specific approach? For anyone looking to lower their risk, diversified portfolio strategies are an option. The mathematical principles behind this theory are complex, but we can illustrate the concept with a simple example. Imagine living on an isolated island with only two companies. One company, like Hilton, is a large hotel and resort conglomerate, operating beach resorts, tennis courts, and golf courses. The other company manufactures umbrellas. Different weather conditions would impact the performance of these two companies. On sunny days, the hotel group thrives, while umbrellas go unsold. On rainy days, the resort business would suffer, and umbrellas would sell well. Let's assume that on sunny days, the umbrella manufacturer has a return rate of -25%, while the hotel group has a return rate of 50%. On rainy days, the hotel group's return rate is -25%, while the umbrella manufacturer's return rate is 50%. On average, half the year is sunny, and half is rainy. If an investor only buys stock from the hotel group, their expected return rate for the year would be 12.5%. The same expected return rate applies if they purchase stock from the umbrella manufacturer. However, please note that this is an expected return rate. If the weather on the island is not evenly split between sunny and rainy days but varies in favor of one condition, the investor's return rate would fluctuate. In other words, they face more uncertainty, which equates to risk. Now, what if the investor evenly distributes their capital between these two stocks? We can observe that regardless of weather fluctuations, their return rate would remain stable at 12.5%. This way, their risk decreases. Although they might not achieve higher returns due to weather conditions, at least they won't incur losses on that 12.5% return. This example illustrates that by diversifying investments, one can effectively reduce risk. Malkiel mentions that diversification has a threshold, which is around 50 stocks. In other words, spreading your money across 50 different stocks reduces risk by over 60% compared to investing solely in one stock. However, the difference in risk between diversifying across 50 diverse stocks and 500 stocks is not significant. In practice, the lowest risk investment portfolio consists of 17% foreign stocks and 83% US stocks. This combination also tends to increase the portfolio's overall return. Diversifying investments helps lower certain market risks and can even boost returns in some cases. This principle can guide us in developing our investment plans. In addition to diversifying investments, we should also avoid people's irrational behavior to navigate around pitfalls. Before investing, we should have some understanding of human investment behavior. When we formulate economic models, we often assume that investors are rational. However, more and more financiers have discovered that many investors' behavior can hardly be considered rational. These irrational emotions and behaviors include overconfidence, judgment biases, herd mentality, loss aversion, regret, and more. All of these can potentially impact stock prices. Let's take the herd mentality as an example. In the 1950s, social psychologist Solomon Asch conducted an experiment. He had 7 participants answer a simple question that even a child could answer correctly. However, he had 6 out of the 7 participants provide incorrect answers before the last person's turn. The results showed that in this scenario, the 7th person also gave the wrong answer. Asch speculated that even when the 7th participant knew the answer was wrong, social pressure forced them to conform. Such situations occurring in the stock market can lead to disasters, as seen in the tulip mania we mentioned earlier and the dot-com bubble of the early 21st century, both of which had shades of herd behavior. What's particularly frightening is that this effect doesn't just happen to the general public but can also affect professionals. In other words, they might not choose stocks based on their research but rather follow the crowd. In 2000, a substantial amount of money from stock mutual funds flowed into high-tech growth funds, resulting in significant losses over the next 2 years. Behavioral finance scholars, through a retrospective analysis of history, have drawn lessons and offered recommendations for dealing with people's irrational behavior. Some of the most important lessons include avoiding herd mentality, refraining from excessive trading, and if you must follow the crowd, doing so with caution. If you must trade, consider selling the losing stocks rather than the winners. And don't trust strategies that claim to be foolproof. So, what I've just explained is the second key point of this book: creating diversified portfolios, avoiding people's irrational behavior, and understanding the information reflected in the market's efficient response. These new investment techniques proposed by Malkiel will help us confront the greatest enemy of investing, which is market randomness. Finally, let me explain the most crucial point to you: how to go about random walk investing. The easiest way to practice a random walk is to invest in index funds through a dollar-cost averaging approach. As we discussed earlier, neither professional fund managers nor specialized funds consistently offer lower risk and higher returns than index funds. So, why not invest directly in index funds? That's correct, but it's not about investing all at once, as buying at a market peak won't help you. Therefore, it's better to employ a dollar-cost averaging approach, purchasing regularly over time, which is an effective method to mitigate risk. In general, the longer an investor holds stocks or funds, the lower the volatility in investment returns. Of course, as mentioned earlier, diversified portfolio investment is also an essential way to reduce risk. Malkiel provides an example of a diversified portfolio for people in their 50s. Allocate around 5% of assets to money market funds, 27.5% to bond index funds, 12.5% to real estate investment trust index funds, and the remaining 55% to stock index funds. This allocation includes 27% for U.S. domestic stock index funds, 14% for developed market stock index funds, and 14% for emerging market stock index funds. If you don't trust index funds and prefer to buy individual stocks, you can adopt a hands-on approach to stock selection. However, there are some rules to follow. Although you can't rely solely on fundamental or technical analysis, you can combine them. For instance, when selecting stocks, it's better to choose companies with profit growth that appears to exceed the average for at least 5 years. Well-managed companies are generally more reliable. This represents fundamental analysis. At the same time, if a company's CEO is an excellent storyteller who can capture people's imagination based on their stories, it's also a positive sign. As we emphasized earlier, stock prices are indeed influenced by public sentiment, which is part of technical analysis. The book also reminds us that even for well-managed companies, you should never pay more than their actual value. For example, if we consider Microsoft, we know it's a very well-managed company, and its stock price is currently over $320. Suppose we assume that this is its reasonable current price. But if tomorrow its stock price suddenly jumps to $1,000, you should think twice before buying, as this price might exceed its fair value. Furthermore, once you've done your research and decided to buy, try to minimize trading. This can reduce transaction fees and taxes, and long-term holding can lower risk. There's a saying on Wall Street worth considering: keep holding profitable stocks, sell losing stocks. If you can effectively combine fundamental and technical analysis, then navigating the stock market with a long-term perspective is a good strategy. Of course, if you find an exceptional random walker, someone like Malkiel, who can manage your investments, and you have faith in their character and ability, you can leave it to them. However, as mentioned earlier, professional fund managers' returns often lag behind those of index funds. So, this method is for your reference only. In conclusion, no matter how you practice a random walk, the method you choose must suit your own preferences. So, that's it. We've covered most of today's content. To sum up, Malkiel believes that the market is inherently random. Pure technical analysis and fundamental analysis can't accurately predict the market, given its unpredictability. Instead of racking your brain and tirelessly searching for patterns in a random market, it's better to follow a random walk strategy based on this observation. Furthermore, long-term studies have shown that diversified portfolios, avoiding irrational behavior, and understanding how the market efficiently responds to information can help us overcome the randomness of the market. Finally, Malkiel presents 3 random walk investment methods: investing in index funds, creating your own portfolio, or hiring someone else to manage it for you. Among these methods, investing in index funds is the strategy Malkiel is most inclined to recommend. After reading this book, my impression is that the investment world is full of uncertainty. Rather than blindly trusting the multitude of opinions in the market, it's better to think critically about the characteristics of the market we face and then formulate a strategy, as Malkiel has done. He offers honest investment advice based on his experience and knowledge. The next step is up to us. That concludes the main content of the book, A Random Walk Down Wall Street. Congratulations, you've completed another book. Thank you for your support and attention. Please subscribe to the Tim Booker channel, and don't forget to like and share with your family and friends. Wisdom is meant to be shared, paving the way for a brighter future. Thank you, and goodbye.